We've seen some chaos in the world markets over the years gone by, haven't we? We go back to the financial crisis, we go back to COVID, we go back to the interest rate and inflation issues. But obviously, this is something that is very, very unknown, probably where Trump is trying to take somewhere or take control over the world. And to be fair, is that a view that we kind of really need to look going forward, or is he going to backtrack on it? Where do we think this is all going to end up?
It's been interesting times, isn't it? I mean, if you think about 5 years ago, we've had one-off lifetime events every year for the last 5 years, and they're meant to be one-off lifetime events, and we seem to have them every single year. I was talking to a client earlier in January, and they said to me, what do you want to happen this year? And I said, I just want it to be a really boring year when nothing happens. And here we are, 2nd of April. Liberation Day, and creates chaos.
I mean, we've fielded a lot of emails, as you mentioned. We fielded a lot of calls that have come in, which is understandably and rightly so from our clients. And the main concern for our clients is, what's happening with my investments? Is it safe? Should I be making changes to the portfolio? Or is it about a case of, as I mentioned earlier, we just sit tight?
Well, it's not a question of sitting tight, but it is a question of analysing the situation. I mean, history shows us that the conventional wisdom is to stay invested, because the trouble with shock events, and let's face it, Trump's tariffs are made up numbers because they're not tariffs. He's included VAT in the UK as a tariff on US goods. Well, it's not. It's on every goods. But the trouble with shock events is when he goes so extreme is you have an immediate market reaction, and markets react very heavily, very quickly. And, if you look at the S&P 500, which is the major sort of tech-heavy US market, you had 3 consecutive days of big falls. And by that time, it's too late to switch out. If you're in at that point, and you have to wait for some sort of recovery. The problem we have is the uncertainty in the market. We don't know whether Trump is using tariffs, extreme tariffs, as a negotiating tool. So if you look at the way he's done it in the past, and his book, The Art of the Deal. Although I think Putin should write The Art of the Deal, not Trump. If the art of the deal is he goes in very heavy, creates chaos, and then rows back from that. And I think probably what the markets are waiting for is some sort of row back.
Yeah, and I suppose going to the complete extreme aside from that is we have had clients to say, do I just go to cash? Do I just put my money under the mattress, because actually I'm going to feel happy, I'm going to feel okay. But as you mentioned earlier, we've had these lifetime events, and we've got charts we can show from a long-standing history that staying invested is the best thing for clients, because as we know, and the funds that we work with, the fund managers will obviously be reducing their exposure to equities. They'll be buying safer assets, be buying bonds, treasury yields. We've done various different types of fund manager calls in recent days and recent hours, etc. And we can see that is actually the positioning had been happening prior to even Liberation Day.
It does, but I mean, the trouble is Trump's tariffs have affected virtually every market. And again, it's not that fundamentally that the companies have changed. They haven't. It's the tariffs that have changed. And if you put tariffs on quickly, he could quite easily take them off, and then we could see a big reversal in the market. And it's 11:45 on the 8th of April recording this, and the Japanese index, the Nikkei 225, is up 6% overnight. The futures in America look like the American markets will be up today. The FTSE's currently sitting at about 1.8 to 2% up. So if you sell to cash and you miss out on the upside days, then effectively you consolidate your loss. And again, with clients with proper planning, you should have cash set aside for what you need now. So we shouldn't have many withdrawals coming out of the investments, because actually they're longer term investments.
And that does come back to our advice though, doesn't it? Because from an advice perspective, we manage cash and investment assets for all of our clients. And obviously one of the scenarios being at the moment is a lot of clients, as I fielded question from, should I be investing in the stock markets? That's the approach that some people suddenly go, I shouldn't be investing there. But again, it's around the risk that we manage, and we've given the advice at the outset, but also it's about that ongoing advice to manage that risk.
Yeah, and if you look short term, markets are down. Had you switched to cash on the 1st of January, you'd be very happy. But again, one quarter is not really an investment term. If you were in for one quarter, you shouldn't be invested. And if you go back from here, if you go back sort of 3 years from where we were, so your funds would be up over 3 years. And I think at some point the penny will drop. You've got hedge fund managers now. You've even got Elon Musk going, hang on a second, what's happening here? This isn't going to work. And I think there's going to be more and more internal pressure on Trump to say we need to row back. The trouble we have with Trump, of course, being the huge narcissist he is that he has to be seen as a way of getting out without losing face. And that's where the art of the deal comes in. I'm sure he's going to negotiate with people and go, I've got a great deal for America. We can take the tariffs off.
Mm-hmm. So coming back to the point of the negativity, but there are absolutely opportunities here as well. So with regards to market crashes, as we said, we've gone through them over a number of years. There is potential for individuals, fund managers to actually capitalize and make money on their investments. But should they invest now?
Again, if you're brave, it's probably a very good time to invest. But you have to be brave because you've just seen your markets come off 10%. One of the ways of mitigating this, which we do quite often, is to put it in on a monthly basis over time. So you phase money into the market. It's something called pound cost averaging. So if you're buying it on a monthly basis and the fund falls, you're buying more units in the fund on the second month after it's fallen. You don't spot price the market. You average the market out over 6 months. But, I always say nothing lasts forever.
No, it doesn't. But I think obviously from our advice perspective, we still wouldn't tell clients to sit in cash. We would still phase it in. We would still invest it, but it's on an individual basis. Because as we've just seen today, the market's already turned today. So, so we're green across the markets. The future markets are likely to come out green. Don't get me wrong. The volatility probably will continue for days to come.
Undoubtedly.
And, as we go into next week, but the opportunities are there. And I think from a portfolio perspective, controlling that risk is what we specialize at doing.
Well, you have to look at what's the objective of the money. If the objective of this money is to say, I'm in for 5 years, short-term volatility is the price for longer-term investments. When we invest money for like junior ISAs, little Johnny's, 6 months old. Well, he can't have the money till he's 18. So actually, time is the big risk mitigator here. Volatility will always happen. And actually, volatility of 10% in a trading year is not that dramatic. It's all come in 1 month, or not even 1 month. It's all come in. But if you go back when I first started, if you go back to 1987, we had the stock market crash. If you look at the graphs now of investments, the 1987 stock market crash, which at the time was catastrophic, is a little blip that you can hardly see. And again, if you'd put money in on the 1st of January 1987 and sold on the 31st of December 1987, you'd have made money.
So taking it back to normal everyday folk, obviously with regards to we've had the inflation, interest rate changes in recent years gone by, and we've started to see some cuts in interest rates. Where are we going to see interest rates going now? Because there could be issues around inflation. We've got the future increases of employers' NI contributions, which were covered off in recent podcasts. They're going to come into effect in this new tax year. So are we going to see further cuts in interest rates? Will it be easier for clients?
Well, I think it depends on the impact of tariffs and how long they last. I mean, I think you can change fiscal policy to stimulate markets and that sort of thing. I mean, it has created chaos, which I think is Trump's intention at the moment. But again, I think at some point he'll row back from it and come up with this fantastic deal for, well, everything's a deal for Trump.
Yes, I mean the chaos is there in the markets now, but I suppose from our perspective is obviously to send that message across the clients, but the message will come back, say, should I stay in the markets? Should I encash it? Or should I invest more money?
History shows that you should stay in the market. If you're in now, you're in because effectively the big offs come in the early days, and we've had the big offs. If you look at the MSCI World Index, you're down sort of 12% in a month. Yeah. Well, we're used to these things being 6% a year, let alone 12% a month. Having said that, of course, it won't take long if that rose back. You have a 3 or 4% on in a day. Suddenly, you're only down 8% in a month, and it's scary. I mean, I can't sit here and say it's not scary for me. I mean, I've got skin in the game as well. I'm invested the same as everyone else, and markets are down, funds are down. But again, it's about looking back and going, what am I trying to achieve with what I've got? That's the big thing. What, if I pull out now and put into cash, yes, I might get 2.5% in an instant access account, which is the same as inflation, so you don't have any money in real terms, but of course it doesn't go down. So people think that if it doesn't go down, it's a good investment, but of course over time it's not a good investment. And to get out now to say I'm going to sell now, and when the market turns I'm going to get in. Well, if you were buying, just taking Japan example, would you have got in yesterday?
No,
because it's up 6% today. So the answer is no, and it's notoriously difficult to spot price the market and say I'm going to sell here and get in here. Yes, we should have all sold in January. We didn't.
But I think it comes back to our advice, though, doesn't it? Because our advice, which we've covered off in previous podcasts, is around having your investments in various different pots to ride out that risk, to ride out the way that you draw the funds out. Because the normal scenario when people are retiring now, people gradually phase in retirement. You need that money invested, as you covered off with the junior ISAs of 30, 40 years. And as markets show us, and history shows us, that actually we come out the other side, and you still get growth on your investments.
I mean, if you think about it, even if you are, so I'm 59, so even if you're retiring in the next few years, which I'm not, I hasten to add, but even if you were, you don't sell all your investments on the day you retire. You keep them invested. So actually, your retirement target might be 3 or 4 years time, 4 or 5 years time, but actually the investment term might be, well, hopefully 20 years or more.
And the thing is a lot of this around mindset. How often do we look at investment markets? Do we look day to day? Because ultimately, it's not meant to be like that.
No, and again, some of the annual reviews we've been doing recently, people are up. Yeah. But it doesn't get away from the fact that it's scary and it's nerve wracking, and that's a natural human emotion. You are going to be worried because, of course, what you're looking at is my funds are coming off. But actually, you're not selling them, and therefore it's currently a paper loss unless you crystallise it. And you only crystallise it when you sell it. And if you don't need the money, conventional wisdom, you stay in the market, wait for it to recover. If you look at, you think about what we've been through. We've had COVID. I mean, this is nothing compared to COVID, and yet COVID bounced back very strongly. We've had the Ukraine war. Yes, that took longer because it's an ongoing conflict, but that took longer to bounce back. But if you look at all the things that have happened, at the time, when people are fearful is really when you should get in because, but I fully understand people who don't want to get in because But
that's where our portfolios may take that fear away in some respects, because they're managed along the scenario of the fact that you're not. We're trying to prevent the big spikes and the big downs, and history shows from the portfolios that it makes sense to stay invested for the long term.
Well, you're right. If you run a diversified portfolio, let's take most people are balanced. So let's say a balanced portfolio. A balanced portfolio will probably have, I don't know,
about 60% equities, something like that.
And of that, 20-30% in the US. So although the US market is down, the actual market is down maybe 10-12%, the portfolios are probably down 5 or 6%. And the other thing to remember is if you've got a lot of money invested, it looks like a huge fall because a small percentage of a big amount looks scary. But equally, of course, when it goes back on, a small percentage of a big amount goes back on very quickly. So it's all about perception. It's all about analysing, staying in the market, and really speaking, if you're one of our clients, then speak to us. If you're someone else's client, then speak to them. But it's a question of being reassured that these things happen. Actually, they're not unusual. It's just that the context of this one is unusual because you've got someone actually manufacturing this.